covered call briefly. Now, if you remember, one of the most important things that you can do in this reading, other than knowing how the strategies are formed, is understanding delta. When the underlying security moves up or down, how does it impact the price or the premium of the option? That's what delta measures. And what we have to recognize is there are call deltas and there are put deltas. Call deltas, basically long calls have positive deltas. Short calls have negative deltas. So when you're dealing in a covered call position, recognizing that with a long underlying and a short call, it's a negative delta being combined to a portfolio delta. A long underlying has a delta of 1. And a delta of 1 basically means that if the price goes up $1, you made $1. If the price goes down $1, you lose $1. It's a 1-for-1 relationship with the movement of the underlying, and that's why it has a delta of 1. A covered call then takes an underlying and adds a short call, which has a negative value. So if you think about it, you're taking a delta of 1 with the underlying and you're combining it with a negative short call delta. So the delta is going from 1 on a portfolio down to something less than 1, like maybe a 0.5. And the reason that it's a 0.5, the interpretation of that is to say, well, if you sold a call on the underlying and the stock goes up, that short call could get exercised on you by the person who bought the call. So the long call will exercise when the price goes up. So you give up the upside. But your downside now, you still own the security. If the underlying starts to move down, you've got a little bit of protection in a short call because you received a premium that's going to help offset the loss on the underlying security. So that's why then if you think about a long underlying having a delta of 1, you took the upside off with a negative delta short call, but you still have the downside delta on the long position. And that's why the portfolio delta, when you take a +1 with a -0.5, you're now at a 0.5 positive, you're experiencing the downside loss. Now, the other thing to think about is what happens, because this option strategies reading does not cover this. This is over in the currency risk management. And most people don't quite get this in currency risk management. And that is the delta can oftentimes represent a premium. So over in the currency risk management, they talk about deltas being 50, 25, and 10. Now, obviously, 50 is greater than 25 and 25 is greater than 10. So I want you to think about a 50 delta as being very expensive. A 25 delta is a little bit less expensive, and the 10 delta is the cheapest. Now, also think about where you're selling the call. So if my current stock price is at $10 and I basically sell a call at that strike at 10, then if I sold a call at the money where the strike and the underlying are exactly the same, then I have a 50 delta and I'm going to receive a boatload of premium income. And if the security moves up a little bit, I'm giving up all the upside. So if you notice, I get with a 50 delta, a lot of premium income, but I have no upside. It's the lowest possible that we could have. But the downside risk is higher because I don't have any downside risk protection, but I did receive a large premium. So with that 50 delta, if I received maybe $1 premium for selling that call, then the security would have to move down to about $9 and I'm still making money, because if it moves down $9, I've lost $1, but I gained $1 from the protective or from the short call. And as you move further and further up the price from the strike of 10 to say 11 or 12 or higher, the delta will move further and further to a smaller value, being less and less of a premium because it becomes further out of the money. So a question on the exam could be this. You read the outline by the client. Client says, I think there's going to be I own the security, +1 delta. I don't believe the market is going to be going anywhere anytime soon, and this security will be flat in its trading pattern, low volatility. I want to generate some income, but I still think there might be some upside potential. So in that position would no longer be a 50 delta. It would now be a 25 or a 10 delta. And if the client says, I want the stock to be able to run quite a bit before I sell my call, that would be a 10 delta. It's far less income, but you have more upside potential with your long underlying position. So always be thinking about what is the risk tolerance of the client. In this case, the more the premium income you receive protects your downside more. So if I sold a 25 delta call with a long underlying, my delta is going to be around 75. I still have some upside, but I got a premium that was something less than a 50 delta, but more than a 10 delta. So that premium income helps offset the downside if the security actually goes down. And that's why they call a covered call a risk management strategy. You may give up some of the upside, you generate income, but you do protect your downside because the loss that you incur is offset by the premium you